Major funding for these broadcasts has been provided by grants from New York Community Bank, M&T Bank, PBM, Customers Bank, Collins Building Services, AmTrust Title Insurance Company, Marks Paneth, Capital One Bank. Additional funding for these broadcasts has been provided by grants from Amerant Bank, Bank of America, Citizens Bank, Dime Community Bank, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties LLC Handler Real Estate Organization, Hodges Ward Elliott Inc., Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Catsimatidis Red Apple Group, Keysight Capital Partners, New Banks, Meridian Capital Group, Ocean First Bank, People's United Bank, RPW Group, TD Bank, and these friends. What's really happening in the residential rental market in New York City? I really don't have the answers. So today, with the assistance of my executive producer, Sean, we're bringing together a group of 3 individuals to talk about the residential rental market spring 2021. Is Sean Riney, who is the Senior Vice President of Investments at Marcus & Millichap, the NYM Group. Jay Greenberg, who is right now in Brooklyn, I believe, correct? Jay is a principal at Z&G Property Group. And last but not least, David Lloyd, the managing principal at Davian Holdings. So, Mr. Riney, since you've brought these people together and since you're the leading investment sales broker around, tell me the truth. How is business today?
Business is, as we like to call this, a coiled spring, kind of like a rattlesnake ready to strike. There's been a lot of pent-up demand on both the buyer and seller end to transact. I would say over the last 60 days, it's been a breath of fresh air. Many of the assignments that we had that we could not hit the pricing on over the fall and winter have suddenly, hit the pricing, and mostly that's been buyers, coming up to the seller's price. Rentals are now moving, and people are having retention where they otherwise had vacancy, which is causing a lot of a positive lift. And all the commonsensical things that you thought would happen of more activity as COVID restrictions, lower, and just more people touring properties, more banks ready to lend. All that's kind of coming into fruition and really shaping up to be a high velocity Q3 and Q4. Like I said, it's kind of like a rubber band. You can only pull it so far back before it snaps, and there's going to be a lot of transaction velocity, setting aside the conversation on pricing. So happy broker for now.
The big question is, 2 years ago, they came out with the Housing Stability and Tenant Protection Act. Okay. Each and every day, the legislation talks about other effects taking place. That really put a pin in the investment sales market. Let's talk to our 2 former investment sales people over there. David, now that you're on the other side of the coin, how do you like the market? Is it a buyer's opportunity? And Jay also, but let's start with David.
Yeah, it's certainly an opportunity. We're buying deals, basically 50% plus off, where they were trading from the peak. So yes, there's been some turbulence in the market with the rent laws and then with COVID, but, that brought opportunity. And, we've looked all over the country, but we keep coming back to New York just because of the value.
So Jay, let's talk about you. What have you done in the last 2 years with regard to acquisitions?
Well, the last 2 years have certainly been 2 different gut punches for investors like us, with the housing laws in 2019 and then COVID last year. And so some of the uncertainty does create opportunity. You find that investors that we have, they're looking in different ways right now, different things, opportunities. Some investors are saying, I don't want to invest at all in New York anymore. And some are saying, I've never seen prices on sale like this in the last 10 years. So it creates opportunities. And what we found is the market's pretty fragmented right now. You have certain product types, fully fair market, tax class protected properties, vacant properties that you could fully renovate without tenants in the way. Those properties are very attractive to investors, very attractive to us. There are other things that we own and that we're looking to buy that you take a pause because you don't know what other regulations are coming down the pike next year. So we have to be careful now, but anytime there's uncertainty in the market and anytime the market is shifting from a low point, it is certainly an opportunity.
You know, yesterday when we all spoke on the phone, we brought up the subject of the 1031. Let's talk about that. If they don't have the like-kind exchange, what effect is that going to have on the investment sales, and what type of effect is it going to have on you, the people who are buying properties? Sean?
It's forcing the issue right at the surface. You know, with the elimination of 1031 exchange, people have to have a gut check, and they either need to do their vows again and recommit to the property that they have, or start that transition now in order to complete the exchange by, the end of the year would be the safe way to do it. So all of a sudden in the last 2 weeks, a lot of these, potential sellers that have had the itch that just haven't scratched it have called us up, hired us immediately. We're rocking and rolling. And I think that there's going to be a lot more sellers that enter the market alongside more buyers, participating. So it's all shaping up to be a Q3 and Q4 of just a lot of velocity. But I think it is putting into focus whether I want to stay with the building, aka remarry it, or I want to find a new bride. And that conversation has to happen right now.
Jay and David, you're the owners. What are you doing today with regard to offering tenants opportunities, with concessions and other opportunities to move into your properties for the vacant units?
For the last 12 to 15 months since we've been in the pandemic, last year around October, we couldn't give away apartments, nice apartments that we renovated, and we try to do the best work in the submarkets that we serve. It was very, very difficult. So we became almost like investment sales brokers and condo sales brokers, where we get involved in the negotiation of the leases with tenants. And I've never had a tenant make a comment to a standard form lease before until this year. And so we started hearing it and listening to what tenants wanted and trying to figure out what drove tenants to sign leases. And it came back to basics. Tenants want certain amenities in their apartments and their buildings that are important to them. The washer dryer in the unit you had to have it, or you couldn't rent the unit. So we're still offering some concessions. They've been dropping. We were down at some buildings 30% off the highs in rents, and you were giving away a month, 2 months. And now that's sort of going away. The velocity of leasing has picked up dramatically, and the prices are going to follow soon after. We're anticipating this summer, as there's more certainty with students going back to school and employees going back to offices. We think that the supply is dwindling, and that it'll be time for rents to pick back up a bit to where they were in 2019.
David, how do you see it?
Yeah, things have been improving by the week. We're leasing 50 plus units down on McDougal Street, the deal we just purchased and renovated. And we started with, several months of concession and, in the eye of COVID, but literally by the week it's been improving, and we're dropping concessions literally by the week. And then, you look at the type of renter that's coming in on the applications, and we're starting to see students, NYU students, as well as young professionals. So it's really the type of renter that's returning is very encouraging. And I think that momentum is just going to continue into the summer.
Why don't we talk about the McDougal deal?
The McDougal Street purchase, it's just it's a great example of the value that was available in the market, during COVID, and then, moving forward to today. This is an opportunity, that was out there for 45 plus million. We secured it for 50% off plus at 22 and a quarter. There was a point in time where it was tough to, tour people through buildings, tough to do lease reviews, and, the sellers really were motivated. It was an estate. And so we started to realize, the way we're going to win this deal is by coming up with a creative solution. We offered a 1-day closing, and, it fit their needs, and we were able to get a great price.
Well, with regard to, closings and everything, it's very important to have the banks over there. How are the banks reacting today on financing new purchases and also refinancing some of the properties that now your tenants that you've been renting up?
Yeah, so the banks have been incredibly active, at least on our stuff. That's what we're seeing. It definitely pays to have relationships, especially during COVID. And that was a benefit to us. But right now, whether we're refinancing or on new acquisitions, the capital markets are humming. We're getting a ton of interest from different types of lenders all across the board. And I definitely, don't think capital is an issue right now if you have the right product.
What about the subject of co-living? That was an item that I remember 2 years ago. It was a big item. Where is co-living today?
Yeah, so the heads and beds model or co-living, that is that's a way you could maximize a layout and maximize your rent per foot. So we were very attracted to that concept. During the pandemic, that kind of went out the door for 6 months or so, and people just preferred space. They preferred outdoor space, more apartment. But now we're seeing the heads and beds model come back really quickly, and that's like I had referred to before, just a function of the young renter coming back. So we're still bullish on that model, and as COVID is more and more in the rearview mirror, we think that market's just going to get stronger.
Sean, how do you see that?
Yeah, I think it's going to come back as well. I think it'll be more on the fringe than a mainstream business plan. We sold a $29 million property on Greenpoint Avenue in the heart of Greenpoint at the beginning of 2020. And I think that even though that buyer may mark the building down from their purchase price, I guarantee you 2 years from now, it'll be well in excess of the purchase price. So, you can't buy what you don't own. And what is nicely renovated will always retain value. So to the extent that you can buy on regular free market rents, and then the upside is the co-living strategy, I think that's a sound, prudent strategy, and it will all come back into play as rents go up and supply gets tight, which we're already seeing 1 month into the lift of the restrictions. It's just funny how quickly that can come back. Momentum is a funny thing.
So which borough do people want to live in? Everybody still wants to be in Brooklyn and Manhattan, or have we seen changes?
Yeah, most of our velocity last year, we have 22 properties in contract right now in between Brooklyn and Queens, and a high percentage of the velocity was in traditional brownstone Brooklyn neighborhoods. And the reason was the rents did not go down that far in those submarkets, and buyers were nipping at the bit to even take a 10% discount off of pre-COVID pricing. And the reason being, most Brooklyn larger unit styles, they're rooted in New York City. They're not the shares. It's very commonsensical why the share market disappeared overnight. No one wanted to work out of a small bedroom. Those people lived to be outside in the city. But those, larger units, people that were rooted in the boroughs, they didn't leave. And, and that part of the market for that reason was very liquid. Probably the easiest thing I could sell today would be a gigantic 5-unit statutorily free market, brownstone Brooklyn, Carroll Gardens, townhouse. Can't get enough of them to sell, can't sell them quick enough.
People were talking about the Bronx, and Bronx always has a good workforce housing. Are we seeing investment sales in the Bronx, and are we seeing Jay and David interested in buying property in the Bronx?
For us, we don't own in the Bronx, and it's not because we don't like it. It's just we don't know it. And in terms of New York City, and I learned this from my former employer and your friend over Yardeni, you got to buy kind of where and where each block by block where you have an advantage. And we stick to Brooklyn and parts of Manhattan where we know. I live in Brooklyn, my partner lives in Brooklyn, and our offices are here. And we want to be competitive where we have that advantage, where we know the blocks, where we can see it even before the listing comes out, or even before Sean gives me a call, I have a property for sale. We want to know what those rents could be if we put our spin on the apartments, and what they are now, where that kind of value is. And so, not that we don't like the Bronx, we just don't know it as well as we know Brooklyn, so we've stayed away.
David?
Yeah, similar point of view. I mean, we've looked at deals in the Bronx. We're not focused there. We're very much focused on the young professional in downtown Manhattan and the better parts of Brooklyn, and that's really been our focus and our bread and butter, and we've been executing really well there. But not to say we wouldn't look at a deal in the Bronx. We just haven't seen anything that works for us.
Sean, do you know what the Bronx is? Okay,
I know what the
I
Bronx
figured
is.
because Detroit, it's similar in certain cases.
There's a tremendous crossover between Bronx buyers and Brooklyn buyers. There's a tremendous crossover between a Harlem and a Crown Heights, Lefferts Garden buyer. Buyers kind of know their locations, but they also know the type of tenant and the rent per square foot that are achieved in parallel markets. There's usually a lot of crossover in. I will say, as a comment to the rent stabilization, product type, in the last 60 days, we've seemed to have hit a floor. Our team has put 7 buildings in hard contract, all traditional $1,100 to $1,200 average rent, elevated, rent stabilized buildings, no quote unquote upside at the moment. And they've all transacted between 9 and 11 times the rent roll. And all of a sudden, there's a market again that I think we've hit the floor on, where if you can be between a 5 and a 5.5% cap rate and somebody sees no downside, the upside might be capped, there's a market. And there's all of a sudden a New York City where there's some type of building for everybody in it. And I do think, lateral moves are willing to be made. I have an owner trading a free market building in Midtown for, trading out of the volatility of a free market building for the stability of a rent stabilized building. So this is an interesting kind of time to mix and match.
Package rooms are a big item, but in these older buildings, there's not enough room. How are you handling as owners, okay, the inordinate number of packages that are being delivered today to the older buildings? Jay, David?
Yeah, this is a topic near and dear to us. We talked to the New York Times about this last year. We were the first building in Brooklyn to have latch as our smart lock system for the doors. And the reason that we decided to do that is because we knew we were buying walk-up buildings without doormen, and we saw just a plethora of packages arriving and being stored in front of the building. And so a lot of times the onus became on the mail carrier to actually get packages in the door. And so we wanted to make it as easy as possible for them. So we started installing latch on these doors so that the FedEx driver or the UPS driver or even USPS can get into the building and put it securely somewhere. And we have our property managers meet them there to show them exactly where we want them. We've used technology in ways to connect with tenants and make their lives easier, because we know when living in walk-up buildings, which a lot of our tenants in Brooklyn want that feel, there are certain downsides to that and difficulties with package delivery, like you said, and deliveries in general, and just mail. So smart locks, connecting with tenants, connecting with mail carriers, and making sure that everyone knows what they should be doing. It decreases package theft, and it allows people to basically have the comforts of a doorman building without the person there.
David, how do you see it?
Yeah, I mean, the package room is, it's almost as important as a gym. I mean, we're looking at a few buildings, one that we're closing on in a few weeks in Chelsea, and literally small room in the basement, and we're thinking, oh, hey, let's make it a gym, and now we're transitioning it and making it a package room. I mean, it's so important right now, especially for the young renter, especially for today and in the pandemic.
With regard to safety, how are you protecting your own building for your tenants to be safe in various locations in Brooklyn and Manhattan?
First thing first, the security cameras, having them there as both a deterrent and something that the police could use if there's an incident that occurs. But more importantly is, especially in these buildings that are smaller, maybe 10 units and below, that don't have doormen, having supers or handyman that live nearby that have a presence at the building is key. You want these people to be both the face of the building and represent you, and also have the tenants feel like there's someone that could protect them as well. Obviously not getting in the line of duty or anything like that, but it just in terms of being there and being a face so the building looks like it's well protected and that there are people around all the time.
Here's a question for all of you. With regard to a couple of years ago, the private equity firms, were very active in buying buildings, and then there were foreign investors. Are we seeing the private equity and the private investors coming back to be partners with you because you're operators in properties? Okay, Sean, you're on the forefront because you're selling all these buildings.
Yeah, I think for the most part, private individuals have been the ones buying properties over the last 12 months. I mentioned a lot of rent regulated trades. Those are almost all private families that are, seeing the same properties that used to be 15, 16 times rent roll at 9 to 10 and jumping on it. This has not been a liquidity crisis. It's been a confidence crisis in New York City. And there's been a lack of confidence in when is the city going to reopen, when are rents going to come back, when can I fill my vacancies, and as all those confidence issues start to clear up, there's going to be a great environment to again buy and sell. But the money is out there. It just needed to feel like it was not making a mistake. Sometimes people are more averse to losing money than they are excited by making money.
What about institutional investors? Okay, are we seeing the Blackstones? Are we seeing, the other smaller institutional players coming in to buy some properties?
I'll just add one thing. You're seeing both of the institutional buyers, and strangely enough, also willing to fund rent-regulated housing, just the same as they were pre-law change, and also chasing smaller 10-unit and under protected tax class, primarily free market buildings looking to assemble a lot of scale. So they bring an institutional lawyering to the table, which I don't always appreciate, but they are active.
The institutions have come back, and we partners with institutions and as well as foreign capital, and it's all based around the narrative shift that we've seen in New York. And I think right now the opinion's forming that New York City is coming back, and you can feel it if you're walking on the streets, and the numbers are starting to show it. So yeah, we've been partnering with institutions, and there seems to be an increasing appetite, and we're looking to do more deals with them.
For the last 6 years, we've partnered mostly with private individuals. And in the last year and a half, it's been more institutions than we've dealt with in the past 6 years. And like I said before, I think the institutions know exactly what they want. They have a strategy, and they're partnering with groups like ours to implement them, because a lot of this strategy revolves around smaller buildings and protecting themselves from unlimited taxes and staying under 10 units and buying fair market units, and so that you can renovate them. And so it's an interesting time in the market, because I haven't seen this many institutions go after these type of properties in a long time. And so it should shape up to be a very interesting next 12 months.
With regard to the subject of work from home, okay, now, it's a big topic of interest. Your buildings are small. Sometimes it's difficult to work from home, especially if they have roommates over there. What do you think is going to happen with the work from home phenomena?
I can't say that it's going away anytime soon. I think that a lot of people that work for larger companies got a taste of working from home and really liked it. I don't myself, but I think that tenants are gearing up to prepare themselves for work from home life at least a couple days a week. And for us, that means tailoring to those needs. Some of those apartments now need, instead of 2 bedrooms, now they're 1 bedroom with a home office that's kind of built out. It's making sure the Wi-Fi is really good. It's making sure that all the things that they need at work are there for them. People are coming back to offices now, which is good to see. But I do think that people will try to keep 1 or 2 days a week work from home. And as small building owners, we have to cater to that and give them kind of the amenities that they need.
As small building owners and also as an investment sales, Sean, let's talk about retail today. The small retail in your building. How are you adapting, and what type of incentives are you offering the retail tenants to be there, because it's an amenity to the building, and also you could use the cash flow?
I'll add one comment. I think amortizing any back rent that you have into a new lease could be a very interesting way to add value moving forward. Mixed use has actually been very liquid in the sense that the retail component of the property was already in turnkey space. So bars, restaurants, something that was already vented with existing infrastructure in place. Savvy investors were snapping that up over the last 18 months, basically, baking in that there might be a reset of rent, but if rents were to go back to where they were, you're looking at a 6 to 6.5% cap rate, and you otherwise would never be able to get that in certain locations. So I think there's a big disconnect between side street retail and Main Street retail, the traditional, corridors of Bedford and Court Street and Steinway. And there's also a big difference in price point. $15,000 a month and under seems to be bouncing back quite a bit. And, again, there's a big disconnect in terms of pricing. If the space is finished, it leases and it's easily sellable. If it's raw and needs a lot of capital investment, it's the same concept as an apartment tenant. They usually don't have $100,000 to build out the apartment, but they can, put up 3 months of rent and start a business. So same kind of concept applies.
Jay and Dave?
Yeah, I think retail is a real opportunity right now. Obviously, over the last couple of years, it became almost a bad word in this industry where you hear about retail buildings and a lot of people don't want to touch them. I think I really like retail buildings. We bought a couple in the past couple of years, and one of the strategies we had was to bring in retail operators with experience that survived the pandemic simply because they had a business that worked for kind of pandemic quarantine living, and now are ready for their second shop or third or fourth. And a lot of these operators are smart. They understand that that they add a ton of value to our buildings, especially when they have a name brand behind them. And so we brought some retail operators into the ownership structure of the buildings themselves. And so if they can protect their own interests by being part owners in the building, it creates kind of a dual incentive for both the owner and the restaurant owner to coexist. I love retail in really good locations right now. Tough deals to buy in terms of capitalizing them, but if you can get them, you can get a really good discount. And like Sean said, you could build a really nice cap rate.
David?
Yeah, we've looked at mixed use. We own a lot of mixed use, but really in prime locations, you can't get too cute with it. But if you're willing to take some vacancy risk in prime locations, yeah, you know, when you're looking at a model, you can build to a very healthy cap rate. And you know, we took that vacancy risk at McDougal, and we leased it up within 2 months. It was a 7,000 square foot retail space and very unique block through, you know, between Minetta and McDougal. And we just knew it when we walked in. This is prime real estate, prime retail. Somebody's going to want this space. It's a unique opportunity. And, you know, we factored in a very low retail rent that was in our numbers, and a restaurateur saw value in being able to tie up a space like that, you know, during the downturn. So for us, it worked. For them, it worked. And we'll continue to look at deals with vacant retail as long as it's in a prime location.
So I think the real comment is location, location, location. That's for everything in business, especially if it's a residential rental building or a mixed-use building. I'd like to thank our executive producer, Sean, Jay, Lloyd, and I'll see you next week.